Do you know what's the most dangerous lie in personal finance? It's not some scam or pyramid scheme. It's way worse. Because it comes from legitimate financial advisors, best-selling books, and every motivational Instagram post you've ever seen. The lie is this: start investing early, even if it's just $25 a month, and compound interest will make you rich. It's complete garbage, and I'm going to prove it to you with math that nobody wants to show you. I'm Tom. This channel is to share my knowledge regarding personal finance and investment, which can make you richer. And I spent my entire 20s falling for this compound interest fairy tale. I was investing $100 a month into my Roth IRA starting at age 22, feeling like I was crushing it because all the finance gurus told me I was doing the smart thing. Time in the market beats timing the market, right? The magic of compound interest, right? 10 years later, you know what I had? $47,000. That's it. After a decade of sacrificing, a decade of not using that money for anything else, a decade of opportunity cost, I had $47,000. Meanwhile, my friend who ignored all the compound interest advice spent his 20s learning high-income skills and starting a business, and then started investing at 32 with $10,000 a month, passed my account balance in 4 years. Here's a stat that's going to make you uncomfortable. According to Vanguard's latest data, the typical 35-year-old today has around $40,000 in their 401k. Not hundreds of thousands, not the millions that the compound interest fairy tales promised. After over a decade of so-called compounding, the median person has enough for a used Honda Civic. And before you think that's just because people aren't investing enough, stick around. Because I'm going to show you that even people who do everything right, who invest consistently from their early 20s, still end up with shockingly little compared to what they were promised. Today I'm going to expose the compound interest traps that everyone falls into. The mathematical lies that sound brilliant in theory, but destroy your 20s in practice. And most importantly, I'm going to show you exactly when compound interest actually matters versus when it's just a complete waste of your most valuable years. If you're tired of following advice that sounds smart but keeps you broke, hit that subscribe button right now, because this video is going to make a lot of people in the finance industry very angry. Let's get into it.
Before we dive into the specific traps, you need to understand what compound interest actually does.
Not the fairy tale version they sell you, the real math. Compound interest is when your investment returns generate their own returns over time. Everyone knows this. You invest $100, it grows to 110, then that 110 generates more returns, so you get 121. Your money grows exponentially instead of linearly. This is basic stuff. But here's what nobody tells you, and this is critical. Compound interest is the multiplication of 3 variables: principal, rate, and time. And everyone obsesses over time while completely ignoring principal. They act like time is the magic ingredient, when really, principal is doing about 90% of the heavy lifting. Let me show you what I mean with actual numbers that are going to blow your mind. You start investing $100 a month at age 22. Over 40 years at 8% annual returns, you end up with about $350,000. Sounds amazing, right? 4 decades of compound interest magic! But watch what happens year by year. After year 1, you've got about $1,200. Basically just your contributions. After year 5, you've got around $7,400. After year 10, you've got about $18,000. So for the first decade of your investing life, while all your friends are making career moves, starting businesses, learning skills that could double or triple their income, you've locked up $100 a month for 10 years, and you have $18,000 to show for it. That's not even a down payment in most cities. Now here's where it gets interesting. Let's look at someone who completely ignores compound interest for 10 years. They spend their 20s focused purely on increasing their income instead of investing. At age 32, they finally start investing, but now they're putting in $1,000 a month. That's 10 times more than the first person, but they're starting a whole decade later. After 10 years of investing $1,000 a month, they have about $183,000. They started 10 years later, and they already have 10 times more money than the early investor had at the same point. And this is where people's brains break. By age 62, the person who started at 22 has about $350,000. The person who started at 32 have roughly $1.5 million. Let me say that again. The late starter has over 4 times more money. They invested for 10 fewer years and they have 4 times the wealth. How is that possible? Because principal matters way more than time when you're dealing with small amounts. Compound interest doesn't perform miracles on $100 a month. It performs miracles on $10,000 a month. But everyone's out here selling you the $100 a month dream like it's going to change your life. And if you're sitting there thinking, wait, this can't be right. Everything I've been taught is wrong. Good, because we're just getting started. Hit that like button if this is already making you rethink everything, because the next trap is even worse. Trap number 1 is what I call the Small Principal Delusion. And this is the biggest scam in personal finance because it sounds so reasonable, so sensible, that people fall for it their entire lives. The advice goes like this. Even if you can only invest $50 a month, start now. Time in the market is more important than the amount. Let compound interest work its magic. I'm about to destroy this with math that's going to make you angry at every financial advisor who ever gave you this advice. You invest $50 a month starting at age 25. Over 35 years at 8% returns, you end up with about $115,000. Now, $115,000 sounds like real money, until you dig into what that actually represents. $21,000 of that is just your own contributions. You put in $50 a month for 35 years, that's $21,000 total. The compound interest part, the magic everyone talks about, added about $94,000. Okay, so compound interest nearly quintupled your money. That's incredible, right? Wrong. And here's why. That $50 a month meant you had $600 a year locked up that you couldn't use for anything else. For 35 years. That's opportunity cost that nobody wants to calculate. What if instead of investing that $50 a month in your 20s, you used it to take courses, buy books, get certifications, learn skills that increased your income by even $5,000 a year? If you increase your income by $5,000 a year and invest that extra $5,000 starting at age 30, you're investing about $400 a month instead of $50. After 30 years at 8%, that's roughly $600,000 to $700,000. You started 5 years later with bigger amounts, and you ended up with 6 times more money than the person who started early with small amounts. But wait, it gets even more brutal. Let's talk about what that $115,000 actually represents in real purchasing power. You invested from age 25 to age 60. Inflation averaged 3% over that time. Your $115,000 in future money has the purchasing power of about $40,000 to $45,000 in today's money. Think about that. You locked up money for 35 years. You sacrificed countless opportunities to use that cash for things that could actually change your income, and you ended up with the equivalent of $45,000 in today's purchasing power. That's not financial freedom. Here's the truth that's going to piss people off. You're not building wealth. You're building a glorified savings account with extra steps and way less liquidity. Now, before the comment section explodes, I'm not saying don't save money. I'm not saying investing is bad. I'm saying that investing tiny amounts in your 20s when you should be focused on increasing your income is a trap. The math doesn't support it. The opportunity cost is massive, and the financial industry keeps pushing this narrative because they benefit from you investing early, not because it's actually optimal for you. And here's something nobody talks about. You know what's more valuable than $50 a month in a retirement account when you're 30? $50 a month toward a course that teaches you how to negotiate. Because one successful salary negotiation could get you $10,000 more per year for the rest of your career. That's $200 a month you could be investing instead of $50. But nobody's selling courses on negotiation. They're selling you on the compound interest dream. So if you're watching this and you're making under $60,000 a year, I need you to really think about whether that money would create more wealth if you invested it in yourself instead of locking it away for 40 years. All right, Trap 2 is even more insidious because it destroyed the best opportunities of my 20s. Stick around because this one's personal. Trap number 2 is the liquidity trap. And this one cost me, personally, over $200,000 in my 20s. I'm going to tell you exactly how it happened and why you need to avoid making the same mistake. Here's the setup. You're 24 years old, making $45,000 a year. You read all the right books, you follow all the smart people on social media, and they all tell you the same thing. Max out your Roth IRA as early as possible. So you do it. $7,000 a year, about $583 a month of post-tax money going into your Roth IRA. And you feel incredible about this because you're being responsible. You're adulting. You're doing what all the successful people say you should do. Then reality hits. Your car breaks down. $2,000 repair. But you don't have $2,000 in cash because you've been maxing your Roth IRA instead of building an emergency fund. So you put it on a credit card at 20% interest. Or you get an opportunity to take a certification course that hiring managers in your industry specifically ask for, but it costs $3,000. You don't have $3,000 liquid because it's locked in your Roth IRA. So you miss the opportunity. Someone else gets certified, promotion, and the $20,000 raise. Or you want to start a side business that could replace your job income within 2 years, but you need $5,000 for a laptop, software, and initial marketing. That money's locked up in retirement accounts, so you never start. The business idea you had at 26 that could have been generating 6 figures by 30 never happens. This is the opportunity cost that nobody calculates. Every dollar you lock away in a retirement account at age 24 is a dollar you can't use for opportunities that might actually change your income trajectory for the rest of your life. And before someone says it, yes, I know you can withdraw Roth IRA contributions penalty-free, but psychologically, people don't do it. You've been taught that touching retirement money is a mortal sin, so you leave it locked up even when better opportunities are staring you in the face. Let me give you the real example from my life that I mentioned at the beginning. When I was 26, I had about $14,000 in my Roth IRA. A friend came to me with a business opportunity. He was starting a company in an industry I understood well. The numbers looked solid, and he needed capital. I could have invested $10,000 for a 20% equity stake. I didn't do it, because that money was in my Roth IRA, and I'd been brainwashed into thinking that retirement money was sacred and untouchable. That business sold 4 years later. My 20% stake would have been worth about $200,000. Instead, I left the money in my Roth IRA where it grew to about $19,000 over those same 4 years. I traded a $200,000 opportunity for $5,000 in gains because I fell for the compound interest trap. Now, not every opportunity is going to be a home run like that. Most won't be. Most business ideas fail. Most side hustles don't replace your job income. I get it. But the point is that when you're young and your income is low, liquidity is more valuable than compound interest. Having cash available for opportunities, for emergencies, for investing in yourself, that's worth more than locking it away for 40 years. The math on this is straightforward. If you're in your 20s making under $70,000 a year, you're better off keeping your investment money liquid in a high-yield savings account until you have at least 6 months of expenses saved and a stable, growing income. Then start aggressively funding retirement accounts. But what do most people do? They max out retirement accounts with $50,000 incomes and no emergency fund. And then they wonder why one unexpected expense derails their entire financial life. Or why they can't invest in themselves when opportunities come up. Here's the rule nobody wants to tell you, but I'm going to say it anyway. Don't lock up money in retirement accounts until you have enough liquid money to handle emergencies and seize opportunities. For most people, that means waiting until your late 20s or early 30s. And that's completely fine. You're not missing out on some magical compound interest window. You're making the smart, strategic play. But Trap 3 might be the most insidious one because it's pure mathematical nonsense wrapped in motivational packaging. And people eat it up like candy. Stay with me. Trap number 3 is my favorite because it's complete mathematical garbage that somehow became the most popular motivational quote in personal finance. You've seen this everywhere, probably on Instagram with some sunset background and fancy font. The quote goes, If you improve just 1% every day, or even 0.1%, the compound effect will make you 37 times better in a year. This is weapons-grade nonsense, and I'm going to show you exactly why, with math that will make you laugh at how absurd this is. The calculation they're using is this: 1.01 to the power of 365 equals about 37.78. So, if you compound 1% daily improvements, you become 37 times better. Sounds incredible, except it's completely meaningless in real life. You cannot improve at literally anything by exactly 1% every single day. That's not how human skills work. That's not how the human body works. Let's test this with something concrete. You can bench press 100 pounds today. If you improved 1% per day, in 30 days, you'd be benching 135 pounds. Okay, that's hard, but maybe possible for a complete beginner. In 6 months, you'd be benching 600 pounds. The world record is about 770 pounds, so you're almost there. In 1 year, you'd be benching 3,700 pounds. You would be the strongest human who ever lived by such a margin that it defies the laws of physics. Your bones would literally shatter under the weight. Obviously, this is absurd. Improvement doesn't compound like that because you hit diminishing returns. Going from benching 100 pounds to 120 is relatively easy with proper training. Going from 300 to 360 is incredibly hard. Going from 500 to 600 is probably impossible for 99% of humans. But here's where it gets really stupid. This same broken math gets applied to everything: your income, your productivity, your skills. People actually believe that if they just improve a tiny bit every day, they'll compound into superhuman results. Let's apply this to money because that's what really matters. People say things like, if you just improve your income by 0.1% per week, you'll be making so much more in a few years. Okay, let's test it. You make $50,000 a year right now. 0.1% weekly improvement means your income goes up by about $50 a week. After 1 year, you're making around $52,600. After 5 years, you're somewhere in the low 60s. That's not compound interest magic. That's not exponential growth. That's a regular cost of living adjustment that doesn't even keep up with inflation in most years. You didn't discover some secret mathematical advantage. You just got a 2 to 3% annual raise. But people frame it as compound improvement to make it sound more impressive and magical than it actually is. And then they use this fake math to justify doing tiny incremental things instead of making big moves that actually change their lives. Here's what actually works in the real world: making major changes that create step function improvements in your life. Learning a high-value skill that doubles your income. Starting a business that creates a new revenue stream. Moving to a higher cost of living city with higher salaries. Switching to an industry that pays better. These are the moves that actually matter. Improving 0.1% per day is a feel-good story that keeps you busy without actually changing anything. You're rearranging deck chairs on the Titanic while telling yourself you're compounding success. The real compound effect in your career doesn't come from tiny daily improvements. It comes from building skills and relationships that create exponential opportunities later. But that doesn't happen by making incremental changes. It happens by taking big risks, failing sometimes, learning from those failures, and making even bigger bets on yourself. So stop falling for the compound improvement lie. Stop sharing those motivational quotes about 1% daily gains. Big moves matter infinitely more than small daily increments. And if you've made it this far, you're starting to see that everything you've been taught about compound interest is either misleading or flat out wrong. And Trap 4 is where we expose the biggest numbers lie of all. This one's going to make you mad. Trap number 4 is the inflation and tax trap. And this is where financial advisors are either lying to you or they're too lazy to show you the real math. Everyone loves to show you compound interest calculations that completely ignore inflation and taxes. And those perfect numbers look amazing until you realize they're fantasy numbers that have nothing to do with your actual purchasing power in the future. Here's the standard pitch you've heard a million times. Invest $500 a month for 30 years at 8% returns, and you'll have about $745,000. You're rich! You're set! You're a success story! Except you're not, because that $745,000 is in future dollars, and future dollars are worth significantly less than today's dollars. If inflation averages 3% over those 30 years, which is actually conservative compared to recent years, that $745,000 has the purchasing power of about $305,000 in today's money. You just lost 60% of your wealth to inflation, but somehow that never makes it into the Instagram posts about compound interest. And we're not done yet, because then there are taxes. If that money's in a traditional retirement account, you pay income taxes when you withdraw it. If you're in the 22% tax bracket in retirement, which is pretty middle of the road, that $305,000 becomes about $238,000 after taxes. So your $745,000 compound interest miracle is actually worth about $238,000 in today's purchasing power after accounting for inflation and taxes. That's 68% less than the headline number they sold you on. But here's where it gets really brutal for young investors. When you're investing small amounts, inflation and taxes hit you way harder because the growth portion of your balance is so small compared to your contributions. Let's say you invest $100 a month for 10 years at 8% returns. You end up with about $18,000. Sounds okay, but with 3% inflation over those 10 years, that has the purchasing power of about $13,000 in today's money. So you locked up $100 a month for 10 years, you took on market risk, you gave up liquidity, and you gained the equivalent of $13,000 in purchasing power. Meanwhile, what if you had just kept that money in a high-yield savings account earning 4%? You'd have about $15,000, which after inflation is about $11,000 in today's purchasing power. The stock market gave you maybe $2,000 to $3,000 more in purchasing power over a decade compared to a savings account. That's it. $2,000 to $3,000 as your reward for taking on 10 years of market volatility and zero liquidity. This is why small amounts of early investing is such a trap. The compound interest advantage over safer, more liquid options is marginal when you're dealing with small principal and shorter time periods. You're taking on massive risk and giving up all your liquidity for essentially pocket change. The math only starts making actual sense when you're investing large amounts over very long periods. $1,000 a month for 30 years creates real compound magic that blows away safer alternatives. $100 a month for 10 years is basically just noise. And here's what really makes me angry. Nobody in the financial industry wants to tell you this because the entire system is built on getting you to invest as early as possible with whatever amount you have. The more assets under management they have, the more fees they collect. They don't care that the math barely works for you. They care that it works perfectly for them. So here's the real advice. Stop falling for compound interest projections that ignore inflation and taxes. Run the actual numbers with 3% inflation and whatever your expected tax rate is. Then ask yourself honestly if locking up that money for decades is actually worth the inflation-adjusted after-tax returns you're going to get. For most people, investing small amounts in their 20s, the answer is no. You're way better off building skills and increasing your income first, then investing large amounts later when compound interest actually has enough principal to work with and enough time to overcome inflation and taxes. But now you're probably wondering, okay, if compound interest doesn't work the way I thought, when does it actually become useful? All right, so when does compound interest actually start mattering? Compound interest becomes powerful when you have at least $250,000 invested and at least 20 years of time. $250,000 at 8% for 20 years becomes about $1.2 million. That's $950,000 in compound growth. That's life-changing money. But $100 a month for 20 years? $59,000 total. Your contributions were $24,000. Compound interest added $35,000. That's a used car, not retirement security. Here's the key insight. Compound interest is a wealth multiplication tool, not a wealth creation tool. It multiplies what you already have. But if you don't have real principal to work with, it's basically useless. So here's the actual strategy that works. Spend your 20s building income. Learn high-value skills. Start businesses. Move to higher-paying cities. Get your income from $40,000 to $80,000 to $120,000 or more. Invest just enough to get your employer match. That's it. Everything else goes toward increasing your earning power. Then in your 30s, when your income is high and stable, start investing aggressively. $2,000 a month instead of $100. That's how you actually build wealth, not the fairy tale everyone's selling you. So let's bring this all together because I know I just destroyed everything you thought you knew about money. The compound interest traps that keep you broke are these. However, you can also enjoy the benefits from compound interest when you hit some points. If you got value from this video, if this changed how you think about money, hit that like button and subscribe because I make videos that challenge conventional personal finance wisdom every single week. No BS, just math and real strategy. And leave a comment telling me if you've fallen for any of these compound interest traps, or if you're going to shift your focus to income growth instead. I read every single comment, and I'll reply to as many as I can. I'm Tom. I post a lot of videos on YouTube to share knowledge about personal finance and investment. Welcome to subscribe my channel to get richer life. I'll see you next week.